All right, this is video number 5, I think. Video number 5. All right, today we're going to be talking about fair value gaps and risk management. Now, before you watch this one, if you haven't watched previous ones, talk about candlesticks, trends, breaker structure, and liquidity. Those are going to be some videos you should probably look at before you look at this one. Other than that, I mean, if you're still following along, if you're up to this point, let's get into it. So, fair value gaps. What are fair value gaps? So, fair value gaps are really like another set of like liquidity, kind of, and it's really like an imbalance. So, what a fair value gap is going to look like is right here. We're going to have, it's going to be a 3 candlestick pattern. So we're going to have one like small one. Usually the middle one is pretty like lengthy, or it's bigger than both of these. And then you have another smaller one. And then from the top of this first candle's wick to the bottom of the last one is going to be our gap, right? Oh, my voice, goodness. But yeah, fair value gap it's just a price imbalance where during strong upward move or downward move, it's the same thing for a red candle, right? Price skips over a range, often acts as a support when revisited. Now, a good example of this getting like tested and just revisited again, it's going to be right here. So what we have here is a gap right here from this. We have 3 candle pattern. We got boom, got this one, then we have this gap here. We came back down, revisited this gap, and then we kept pushing up, came back, touched it again, and it's just an imbalance in the market, and market loves to come and touch it again and continue in that certain direction. That's really all it is for fair value gaps. It's just 3 candlestick pattern. Got a small, a bigger one, and then a smaller one again. You're gonna mark the top of the wick of that first candle to the bottom, and I'm gonna show you how to mark it with the rectangle tool on TradingView, so we know how to mark these. But yeah, that's what a fair value gap is. It's just an imbalance in the market when we're making strong pushes up or down and we skip over range, and we like to come back and retest it and just keep going, or sometimes this will happen. This is what we call an inverse fair value gap. Now, an inverse fair value gap, like with a breaking structure, could indicate a reversal. And this is another tool you can, or another confluence, I'll say, you can put with, like when you get liquidity sweeps and you get a breaking structure. If you don't get a breaking structure, you can look for an inverse fair value gap to also put in a trade, because if we just break through that gap, that's telling us we're really strongly pushing through that, and we don't have any buyers or selling keeping the momentum, but we push straight to it, and it can signal a change in direction or breaking structure, or reversing. You get the gist. So yeah, that's the pictures I have. So now we're gonna go look for some, right? So if any of y'all want to write this down real quick or take note, this is what the definition, or like what it's pretty much is: just an imbalance when we move pretty quick, because market loves to stay balanced, and when we don't stay balanced and we create imbalances, we love to come back and touch those and keep going, or we inverse them and so on. So now, since we learned about fair value gaps, this is the thing I was trying to tell y'all about that I couldn't show y'all yet. But when we looked at liquidity the other day, right? We're gonna go back to this liquidity. Was it this London high? We have. I'm on the 4-hour. Whoops. All right, boom. We're gonna go back. So remember, we had our we have liquidity that we mark at session highs and lows, and we wait for that to get hit. Now there's 3 steps into when liquidity gets hit is what you want to look out for. Or really, it's like 2, or the first step ideally is wait for the liquidity to get hit, obviously, right? So this is the New York session we opened here. And let's say you're waiting for this high to get hit. So we're going to be patient. We're going to wait for this high to get hit. Boom, we come up and bang. We hit this liquidity. And now we're on the 5-minute time frame. We're going to go and find, or I want you to, before I mark it, I want you to go ahead and in your mind try to guess where, or mark some in your head or wherever, where are some fair value gaps at. I'm gonna give you a second, and then I'm gonna show you how to mark them. But the way you're gonna mark them too is if you go to geometric shapes. I can't even talk. Holy cow! You're gonna go to rectangle, and you're gonna star that right there. Now I have your rectangle tool. You have your rectangle tool. We're gonna click that. Also too, I have my weak magnet thing on just so it helps me mark it easier. But yeah, I like to have this little cross thing too. But yeah, we have our tool. So boom, here and here we have a gap. It's kind of small, but this is technically a gap right here. We respected it just a little bit, then we closed straight through it. And to mark these, you would just do 1 minute FVG, stands for fair value gap. Ooh, that's kind of small. All right, boom. You do that, and the same thing I showed you how to save your highs and lows little template. So what you would do is you click on this. When you type it out in the settings thing, you would go to here. Then you would do save drawing template as 5-minute FVG save. Now, when we mark it again, we drag this out. We can go here, and boom, we have our fair value gap labeled. We also have another fair value gap right below it, right? Boom, boom, bang. Right. Then we have another one right here. So we went through 3 fair value gaps, but you could ideally get in after this one gets broken through, and then get in your trade. So that's like 2 confluences you could wait on, or you wait for one or the other, or both. Obviously, waiting for both is going to be more confirmation. You're going to be more sure, but you could also look at this on the 1 minute and look for if you want to get in. If you wanted to try to get in early, could I go back this far? Yeah. If you wanted to get in early on this trade, right? Try to spot a inverse fair value gap. We have a 1 minute fair value gap inverse. If we go here, mark this right here. This is our 1 minute. We inverse right here through this. We close straight through it. This could signal us a price going back down and reversing off of this, but it could be a little early on the 1 minute, because the 1 minute can be kind of choppy. So I personally would recommend to look for entries on the 5 minute, but if you go down the line, you end up liking entering on the 1 minute, feel free. But I'd recommend start on the 5 minute. Then when you get a little bit more confident, you start understanding things a little bit more, then you can go down to the 1 minute and try to do it. Because if you got into as soon as the inverse boom, you would just be in a little bit of drawdown, like your stop loss is somewhere up here, right? You would be in the red for a little bit, but then eventually went to where we thought it was going, right, which was selling off. So it just involves a little bit more patience. But let's say if we try to wait for an entry on the 5 minute, we inverse this one, we opened up another candle, then we closed here. So if you wanted to enter here, right? Did I delete the line? Hold on. I did delete it. Holy crap. Okay. Like I was saying, yeah. Liquidity got taken. Boom. We have our gap. And we inversed. Then as soon as this candle closes, you get in. Stop loss, wherever. I don't know where your stop loss would be, wherever it would be. And we're going to be able to, I'm going to show y'all how to determine that later on. But boom. That's another good entry model. right? Remember that V shape? You can even call it like, okay, boom, liquidity got hit, V shape, breaking structure would be here, plus inverse fair value gap on the 5 minute. Or you can be like, okay, you could also do this too. If you get, let's say you get a breaking structure on the 1 minute, and then you get an inverse on the 5 minute, you could wait for both of those. You could wait for one or the other. You could just wait for one. You could just wait for a 1 minute breaking structure, 1 minute inverse fair value gap, 5 minute breaking structure, or 5 minute inverse fair value gap. You could do both. You could do just one, whatever you're comfortable with and you feel more confident in. That's what I would do. But for now, I would recommend on the 5 minute do have your entries, but you know, experiment how you want to, and then you'll learn as you go. Maybe I was entering too early, maybe I was entering too late, whatever. You'll figure it out as you put in trades, because right now we're actually almost ready to put in trades, right? We're getting trade ideas right now of liquidity sweeps, right? So your plan for like anytime you want to get ready to put in a trade, when you go into the market, when the market's opening, you want to have a plan. So mark your liquidity. So at your session highs, your session lows, wait for them to get hit, wait for inverse fair value gap, breaking structure on the 5 minute, V-shape reversal, and then you enter, right? And then we're gonna talk about risk management in the next video, but today this is just pretty much the steps on how to like take trades, because this is like this is really, I'm gonna be honest, you almost know like pretty much everything I know. Like if you up to this video, I don't really know like every single thing. I kind of know like the basic. I keep it pretty simple. I don't overcomplicate things. For me, wait for liquidity to get hit, inverse fair value gap or break a structure, and we enter. And then tomorrow we're gonna learn about risk management, and then from there we're gonna be able to put in trades and get our confidence up and learn about it. So yeah, that's what the two confidences are: breaking structure and inverse fair value gap, or a fair value gap being respected, right? And basically, fair value gap being respected, it just shows it's probably going to continue in the same direction, right? So let's get rid of this high because that was old. This is like new. But we mark this fair value gap, we can see it getting respected. Price often loves to come down, right? Touch our fair value gap like so and keep going, because it's just filling an imbalance. We moved up so quick here, boom, it just wanted to fill this imbalance, and then we keep going, right? That'll happen pretty often in the market. It happens a lot. Like it happens here, like here, see, we're respecting this fair value gap. Let's see, here, right, respecting this fair value gap. But you see too, we came down, we inversed this gap here. But just keep in mind, not every inverse fair value gap equals a reversal, because it's not a high probability that it will reverse. It's high probability when you see an inverse fair value gap after liquidity has been hit, right? So just keep that in mind. But yeah, that is it for value gaps. We're gonna talk about risk management tomorrow, and then we're gonna, well then yeah, y'all are pretty much ready to start putting in trades and starting to get a hang of things. So yeah, any questions, let me know. I try to explain this as best as I can. Hopefully, I can understand it the way I explain it. Try my best. So just let me know if you got any questions, and yeah, I'm out of this thing. Peace.